$639 billion in assets linger on Lehman Brothers' balance sheet, but $613 billion in liabilities loom ominously, and cash reserves are dwindling. The trading desk faces relentless pressure as the market for mortgage-backed securities collapses, prices plummeting 40% in just weeks. The phone rings incessantly in the risk management office, each call signaling another downgrade from credit agencies, pushing the firm closer to disaster. At 10:30 a.m., the head of capital markets receives alarming news. The stock price has dropped 12% in a single day, now trading at $16.50. The team scrambles for options to shore up liquidity. They consider a capital raise, yet investors retreat. The last equity offering was met with skepticism. Potential backers now hesitate due to the firm's exposure to subprime mortgages. An internal analysis reveals the leverage ratio creeping dangerously close to regulatory limits, further constraining their options. By noon, the atmosphere thickens as the firm's liquidity position deteriorates. An emergency meeting is called with the executive committee. The CEO pushes a plan to sell off non-core assets, but the market for these assets has evaporated. They discuss selling the commercial real estate division, yet bids come in at 30% below expectations. Urgency escalates as analysts warn that the firm might run out of cash within days if the market continues its descent. The CFO states that without immediate action, a liquidity shortfall could strike as early as Friday, just 3 days away. At 1:15 p.m., the chief risk officer reports a major counterparty demanding additional collateral on an overnight repo agreement. Lehman's liquidity is already strained, and this demand tightens the situation further. The firm scrambles for assets to pledge, selling off short-term securities at a loss. The repo market begins to freeze. Lenders grow increasingly reluctant to extend credit, and the cost of borrowing spikes. A review of their balance sheet reveals an alarming amount of illiquid assets, complicating their ability to meet collateral demands. By 3 p.m., the situation worsens. The trading desk reports massive sell-offs of mortgage-backed securities, with bid-ask spreads widening significantly. The firm's risk exposure intensifies as they hold a substantial amount of these securities, now trading at 50 cents on the dollar. The CEO calls for an emergency board meeting to discuss a potential bankruptcy filing, fully aware of the implications. The board members are briefed on the deteriorating market conditions, and the urgency becomes palpable as they weigh options between seeking a buyer or filing for bankruptcy. At 4:30 p.m., the board convenes. Discussions revolve around the potential sale of the investment bank to a competitor, yet key players in the industry express hesitation. The market has lost confidence. The CEO proposes a last-ditch effort to secure a liquidity backstop from the Federal Reserve, but the Fed indicates it will not intervene without a credible restructuring plan. The board debates various restructuring options, but the tight timelines and lack of viable buyers complicate their decision-making. As the trading day closes, Lehman Brothers stock plummets to $10.50, a 37% drop, as credit default swaps spike, signaling increasing risk of default. The firm's reputation lies in tatters, and potential buyers pull away. The stark reality that the firm may not survive the week sinks in among the executives. The legal team begins drafting documents for a bankruptcy filing, anticipating that options are rapidly vanishing. The next morning, reports surface that a major hedge fund has started to unwind its positions in Lehman's securities, triggering a cascading effect. The price of their bonds falls further, and the firm faces margin calls across multiple desks. They must liquidate more assets at a loss, leading to further erosion of capital. The trading desk reports that remaining liquidity has dropped below $1 billion, a critical threshold for operational viability. By midday, the liquidity crisis deepens. Lehman's ability to finance operations is severely compromised. Prime brokerage clients begin withdrawing funds. The trading desk is notified that several key clients are moving their accounts to competitors, fearing insolvency. This exodus exacerbates the cash crunch, leading to higher borrowing costs. Analysts calculate that if the trend continues, Lehman could face total capital depletion within 48 hours. At 3 p.m., the firm receives a formal notice from a major creditor demanding immediate repayment of a $2 billion loan. Executives convene to assess the damage. They decide to prioritize repayment, but this choice further constrains available liquidity. The firm is left with under $1 billion in cash reserves, and discussions shift to potential asset sales that could provide immediate cash flow. Yet the market remains unresponsive. As the day draws to a close, news leaks that Lehman Brothers is actively seeking a buyer, but offers are insufficient to cover liabilities. The firm's stock price tumbles again, settling at $5 by market close, representing a staggering 70% loss in just 2 days. The looming reality of bankruptcy intensifies. Lawyers prepare for a Chapter 11 filing, while discussions about restructuring options face skepticism from board members, complicating the path forward. On September 15, 2008, Lehman Brothers files for Chapter 11 bankruptcy protection, holding $639 billion in assets against $613 billion in liabilities. The immediate impact is staggering. Counterparty losses ripple through the financial system. Major banks report sudden write-downs, and the interbank lending market freezes. A credit squeeze triggers a collapse in asset prices across the board, costing the stock market hundreds of billions in value. In the ensuing weeks, the fallout continues. Major financial institutions report billions in losses, and the global economy begins to feel the strain. Layoffs ensue as banks cut costs to cope, with over 150,000 jobs lost in the financial sector alone. The crisis escalates into a global recession, GDP contracts, and consumer spending plummets. The consequences of Lehman Brothers' decisions reverberate through the entire financial system, altering the landscape of global finance forever. In the end, the collapse of Lehman Brothers reveals the fragility of financial systems, where confidence can evaporate in a matter of days, leading to consequences that resonate far beyond the initial failure.